Okay, we're still ticking up a little bit in attendees and participants, but I thought we'd go ahead and get started today so that we could utilize the full hour that we have today with our guest speaker. I want to welcome everybody to the AAMC first webinar series. My name is Jonathan Chancellor. I'm an education debt management specialist with the AAMC, working with the first team. And we're joined here today by Miss Veronica Herrera. She is from Experian. We wanted someone who is an absolute expert in credit to talk to you today. So hopefully all of you, when you got the email and the notification about this webinar, you noticed that we're doing a little bit of a change in format. So today what we're wanting to do is we're wanting to make this webinar a little bit more interactive. We want all of you to ask questions so that you can actually speak directly to Veronica. Both of us feel like you think you're gonna get a lot more information that way rather than us just talking at you for an hour. So we wanted to try to do a little bit of a format. So what we're going to do today is you have two options. You can type in a question in the Q&A box, and I will happily read those to Veronica, or you can raise your hand. Now, I'm going to make sure that that does work. This is our first time trying this new format. So if you do have a question and you're comfortable with asking that in front of everybody, you could raise your hand. I'll make sure that you're off mute, just see that if you want to ask that question. But we want to do it that way today, just in order to try something new, make sure that we address everybody's questions. Because again, we did send out a video that Veronica recorded earlier that had a lot of the basics, high level about credit. We wanted to make sure that this hour actually answers things that might even be beyond that. Now, of course, if you weren't able to watch the video, please ask your questions. We're not telling you not to, but we just wanted to make sure that you had a high level understanding of what credit was. And what Veronica is going to do today is really dive into even more things about credit and the importance of credit and establishing credit. So Veronica, if you don't mind, could you just tell everybody a little bit about yourself first before we get started?
Absolutely. Good afternoon, everyone. I'm so pleased that so many of you have joined. Excuse me, I've got to move my cat out of the way. I've been with Experian. I started 20 years ago, actually, this July. So I've been around for quite a while. I've worked in many different divisions, primarily in what's called analytics. So I'm responsible for scoring and decisioning. I worked as a consultant for our major banks, so I know what lenders are looking for. And most recently, I moved to the consumer side of the business. So my primary job is empowering consumers to understand and improve their credit. So I do this on a volunteer basis originally, and I have somehow made it into my real job. So this is awesome. And again, as Jonathan mentioned, if you saw the video first, that will give you a basic understanding of all the terms that I'm going to be using, right? Credit reports, credit scores, all these different things that you're going to need to want to know. But what I really want to do today, and I want this to be very interactive, is I want to hear what your questions are, what your concerns are, some of the things you've heard. I will tell you that there's a lot of misinformation out there, people who believe things and try things that, don't work. I'm here to kind of set the record straight, but to answer all of your questions. Now, I can't, excuse me, my cat is really being a pain today. I cannot do anything to your specific credit report because I don't have access to it. But I can definitely answer whatever questions you have, any concerns, give you resources. But this really works if you, get off mute, ask your questions, and, really participate in this.
Well, we actually do already have a couple of questions, Veronica. So let's just go ahead and start with those. Actually, we have about 3 or 4, so they're coming in already. So let's just start with the first one. What are the best practices for using a credit card as a medical student to build credit?
Excellent question. Use it. Now, I'm not saying get into debt, okay? Use it to the extent that you can pay it back. So if you want to use it for a few purchases, even larger purchases, make sure you can pay on time. It's critical for building your credit report. The reason I tell you have to use it is a lot of people don't use their credit cards. And guess what happens? Your lender's going to close you. If you do not use your credit cards, then you're just an expense to them, and they will close your credit card. And when they do, it gets marked on your credit report as grantor closed the account. Okay, so the lender closed your account as opposed to the consumer closed the account. And when a grantor closes an account, it is considered worse. It is definitely seen as a negative. So if you want to start building your credit little by little, not getting into a lot of debt, but just start using it, do so. And be aware that if you don't use, usually most lenders go about 2 years. If you don't use your card after 2 years, they'll just send you a letter and say, we've closed your account. So be aware of that. But other things are keep your utilization, under control. As I think I mentioned in the previous video, the sweet spot is 30% of your credit limit or less. That's perfect. Play around with that. But as you start getting higher and higher and higher, you're going to start noticing your credit score is impacted. If you want to improve it, just bring it down to around 30 or below, and you're good to go. And the other thing that I might also suggest is you should probably have more than one credit card for many reasons. But having one single credit card really makes you a very thin file, and it's harder to score, and you haven't built up that reputation. So maybe have a few.
Great. We have some good questions coming in, so
This is awesome. Okay.
Yeah, and I like they're very unique. I haven't heard some of these before. So what
Okay.
mistakes do 20-somethings make that follow them for the longest period of time?
Oh my goodness, I'll tell you right now, it's thinking that you don't have to pay a particular loan because it's not a loan. Here's what an example, and I've seen this so many times. When you sign a contract, let's say at a gym or to some other thing, and you agree to pay and you don't, simple as like, I don't go to the gym. Why should I pay my gym membership, right? If that goes to collections, that is a ding on your credit report. And that's even worse than having a credit card go to collections. And I'll tell you why. At least with a credit card, you have the credit card history plus the collections. With a non-loan type of collections, or like a medical collections or something like that, you only have the negative. There's nothing else positive kind of balancing that out. The biggest mistake is not being aware that when you enter into a contract with someone and you agree to pay with, whether it's a loan, a credit card, or something, or a service, that those things can go to collections. And guess what? Those things stay on for 7 years, and they are pretty darn impactful. Now, you can mitigate that if you do get a collection account for whatever reason by paying it off. Because once a collection account is paid off, even though it stays on your credit report, it's not used in most scoring models anymore. So the data is there, but it's not going to count against you, and eventually it does fall off. The other thing, another mistake that I think people make is besides the obvious, which is taking out a loan that they can't repay, is if you are running into some trouble, if you are experiencing, maybe you don't have the income that you were expecting, and you're having trouble paying your bills, whether it's a credit card or a loan or whatever's due, the biggest mistake that people are making is just kind of burying your head and saying, well, there's nothing I can do about it. There is. Talk to your lender. If you are having trouble, you need a little bit of help, ask them, tell them, look, I can't make the full payment. Can we adjust something? What you don't want is the lender reporting you as late or behind schedule. You want them to, keep that relationship with you open, make a new agreement, but don't just ignore it, because those things, again, they stay on for 7 years. So it's important to handle them quickly. What?
So a good question is, why would someone's credit score stay exactly the same for a few years?
Well, technically it's not, okay? Theoretically, your score is fluctuating, could be technically on a daily basis. What you might be seeing is whenever you log in, it's about the same, or it doesn't, unless you do something significant like go late or file bankruptcy or default on a loan, you're not going to see wild swings. You're going to see little minor, a couple points up, a couple points down. So it may look like it's steady, but technically a score is fluctuating slightly, mostly because of credit utilization. One reason why it may not have been moving is because you're not doing anything with credit. You're not opening new accounts. New accounts are being closed. Your utilization isn't varying. The good news is that if it's at a pretty decent score, it not changing much is actually a good thing. If what you're saying is my score is kind of low and nothing is raising it, well, we're going to be talking about ways to help raise your score today.
Awesome. I have only one credit card. Is it advisable to have more than one to have good credit? And if so, would that be ideal?
Okay. So yes, it's definitely advisable. First of all, you should always have at least one, preferably more. People say, well, what's a good amount? As many as you can have. From a credit standpoint, I should say. Now, I am not talking about using those credit cards or maxing out or, adding balances, because when you take out debt, yes, that can have a negative impact. But having a credit line, right? 50,000, 100,000, these are great. So if you need to have, I have personally, I think I have 8 credit cards. I don't use all of them, although I do try to rotate. I have my favorites. I have the one that I use a lot because it gives me the points that I want. And this other one is great for my Amazon purchases, right? So I kind of play around a little bit with it, but I keep all the utilizations low, try to pay them off as much as I can. But from a credit standpoint, the more the merrier. Just be aware that if you're going to use them, okay, using them means you are taking on debt. And as long as you can pay them off, no problem.
Great. I think what we'll do, Veronica, if you're okay with it, we'll do about 2 or 3 more. And then I wanted you to go through some of those, that data that you had on some of those slides, if that's okay with you.
Absolutely.
Because that would be awesome. But there are some really good ones that I know you and I have touched on. One is in terms of student loans. How will participating in the public service loan forgiveness program, which is paying the minimum amount back, affect my credit?
Okay. As long as you're paying on time, it's improving your credit. So go.
Yeah, exactly.
For you. Paying off, when people say, should I pay off my loans more than the minimum? Yes, because that reduces your debt. But as far as what's called payment history is concerned, which impacts the credit score the most, just paying on time. So you want to pay a minimum. I got to tell you, my daughter's doing that exactly. She has a loan right now. She got out from grad school. And she knows that her loan is going to be forgiven. I think next year is when she meets the minimum requirement. So she's kind of making the smallest payments necessary, but always on time, okay? Because she knows that the bulk of that is going to be forgiven. So the answer is just make sure that you're making your minimum payments on time.
Great. So this is someone who says, I will be getting my social security number with which I'll be able to get a credit. I'm moving from the US from Colombia to start my residency and would like to know how to start doing that.
Okay, fantastic. Technically, you don't need a social security number to get started, but it always helps. And you can you can. And I'm going to be talking about how to start your credit report. In fact, that's part of the presentation that I'm going to be giving today. There are several different ways to do so. But congratulations on starting off as early as possible. That's great.
How does closing your account for non-use affect your credit score?
Okay, it affects what's called your utilization, your balance limit ratio, and the number of open accounts that you have. So credit scoring models are looking at a variety of different things on your credit report, right? One of them is the credit card utilization. How much balance and how much money have you taken out and used on those credit cards divided by the limits. The minute you close an account, your denominator, your limit, gets reduced. And what that does is it makes your utilization get higher. Okay, so you've got to be very careful on closing accounts. I'm not saying you can't, or that you shouldn't, or that your credit's going to be ruined, because the reality is, to fix that, just get another card that had at least the same limits, and you're actually where you were before. But that's how it affects it. Also, every time you close an account, even though it stays on there for another 10 years, eventually those fall off, and so your credit report could start getting thinner and thinner. You know what? There was another question right before that about mortgage rate comparison.
That's what I was going to go with right next. I want to see if you
Yeah.
can answer that one. So really,
That
can
is
you explain
great.
how multiple hard inquiries to shop around to get the best rate for a mortgage impacts your score?
Absolutely. So the first thing I want to say is that rate shopping does not just apply to mortgages. It also applies to auto loans. And now they're going to be applying it to student loans, in particular private student loans, things like that. Okay, so what's happening is, for big ticket items, like your education, your car, or your house, you don't want to take the first loan that comes your way. You want to shop around and see which lender is going to get you the best rate, because we're talking hundreds of thousands of dollars in interest rates, and it can be really substantial. So every point is worthwhile. But people say, well, wait a minute, when you get too many inquiries, doesn't that knock your score down? Yes, it does. So the answer to that situation is that modelers and the people who create this credit scores, they think of it as an exception for these types of loans, not for credit cards, by the way, because if you apply for 5 credit cards, you could get all 5 credit cards. But if you apply for a mortgage 5 times in, let's say, a month, we know you're not taking out 5 mortgages. You're taking out 1 mortgage. So the way the models handle that is they group like inquiries in a short period of time. Anywhere between 2 weeks to a month is generally the normal window. And they say, when we see the same kind of inquiry in this period of time, roll them up and count them as 1. So do not be afraid to rate shop. The score will only see that all of those inquiries as 1. Okay, you're going to see it on your credit report. You're going to see each and every one of them, but the model only looks at 1.
Great. What do you think, Veronica? Do you want to go through a few things on your end, or do you want to keep going through some questions? We're getting great questions. We still have another good 20 or so that are out there.
Let's keep going with the questions.
We'll keep going.
If a topic comes up, what I'll do is I will bring up the slide.
Perfect.
Talk about that, okay?
Here's one that I could say can definitely relate to me. So I made some mistakes when I was younger, went through some bankruptcy, had a large amount of student debt. How long after on-time payments on these loans will I see my score start to increase?
Okay, so bankruptcy in particular is a tough one, because a lot of lenders obviously look poorly on that. So usually it takes at least 2 years after a bankruptcy to start getting into that position where you will be, granted loans. But you're asking how can I start improving my score after a bankruptcy or a very negative? Let's not even say bankruptcy. Let's say a charge off. Okay, you stop paying completely on a credit card, they're going to charge it off into collections or repossession or anything that's pretty negative. How long do you start seeing the impact, the negative impact? 2 things. One is time. The other is what else is balancing it out. Okay. So I guess what I'm saying is, if you have a very thin file, let's say you only have 1 or 2 accounts and one of them goes completely bad. Yeah, it's going to take a while because you only have one other account that's balancing that one out. Okay. So in that case, the more you build your credit history, having 3 or 4 accounts, maybe, or more, that are paying on time, that's going to start counterbalancing the impact of that negative score. But the reality is that it takes time. And I'm going to say that to really start seeing an impact, it's going to take about 2 years for something really negative. If it's just a late payment, no, usually about, maybe a year later, you're going to start seeing that the impact of that really starts going down. And the older the negative is, let's say it's getting close to 7 years, because that's when it drops. Okay. You're going to start seeing by year 5, year 6, close to year 7, the impact is almost gone. It's very minimal, but only if there's good to balance that out. Okay, that's important.
Great. So what about in terms of building credit? Is there a difference between paying off a credit card in full each month or carrying over a small balance? What's the difference in that?
Okay, so from credit building, none. The credit building is, are you paying your bills on time? So whether you pay it all off, the way that impacts you is, 1, you don't have debt if you paid it all off, right? You don't have any outstanding debt, and your utilization was looking really good. But even carrying a small balance, not a problem. Here's a little trick or a little hint that you guys may not know. And this is just a function of models. It's not anything against anyone. But people who always carry 0 balances on their credit card actually show a little bit higher risk, not a bunch, I'm talking a few points, higher risk than people who carry a little bit of a balance. Okay. Now, the problem with carrying a balance is that you're going to get charged an interest rate. So you've got to balance that out as well. But if you do not use your credit cards, or you carry a 0 balance month after month after month, your score could theoretically go down a few points. And I say theoretically because, again, it all depends on what else is on your credit report. These actions do not happen independent of each other. They happen as a whole. What do you look like from a consumer standpoint as a whole? How many accounts you have? What type of accounts do you have? How much outstanding debt? Do you pay your bills all on time? All that. All those things working together are what calculate your score, not any single action. Okay.
Right. So this one says, is it true that if you have a loan with a company and they don't report it to the credit reporting agencies when you make payments on time, that they can report it just when you're late?
Yes.
Oh,
Reporting is not a mandatory action. Um, I hate that.
yeah.
You know who's really good, who does that a lot? Utility companies, cell phone companies. They don't report your good payments. They report only when you stop paying. And I personally feel that that's very unfair. In fact, Experian thinks that's very unfair. That's one of the reasons why we created the Experian Boost program. I don't know if you guys have heard of it, but Boost is a way for you as a person to say, you know what? I want my good payments on there too from people who don't normally report, like utility companies, cell phone companies, rent, now insurance, right? These are places that if you mess up, oh yeah, they're going to be reporting you. But if you are on time, they don't. It's like, well, okay, so we're going to say, I'm going to let the consumer, the person say, yeah, I want my good stuff on there too. And that's Experian Boost, totally free. There's no charge for it. If you're interested in finding out a little bit more about that, how to add what's called consumer permissioned data. That's what it, CPD, consumer permission data. It's where the consumer says, yeah, I want this added to my credit report. Go check it out. It's completely up to you, free. There's no obligation, but it might help you, add some good data to your credit report.
Good, good. So what if somebody signs up for something like debt consolidation through national debt relief? How quickly can you see your score increase from something like that?
Well, okay, so debt consolidation, what people don't realize is debt consolidation doesn't improve things for you right off the bat. It helps you as a person. It doesn't necessarily help your credit right off the bat, right? Because the debt's still there. All you've done is reorganized it. So when we're looking at how much debt you owe, it's going to be the same. And in fact, when you take a debt consolidation loan, usually you are starting at the maximum, right? So remember we're talking about utilization, balance to limit ratio. Well, when you open up one of these accounts, you're at 100% utilization. Now, every month, of course, it goes lower, but at the very beginning, it might actually technically have a little bit of a negative impact on your credit score, okay? But if it helps you pay your bills on time because now your bills are manageable and it's a point where you can actually make that payment, then it's a good thing, okay? So just be aware that loan consolidation is not some sort of magic wand that's going to fix your credit. It's to help you manage your bills so that you can pay your bills on time. And that is what's going to help improve your credit. Okay.
That's a good point. That's a very good point. So somebody wants to know, why did my credit score drop when my student loan servicer changed? And what can I do to improve my score?
Okay, so when your student loan servicer changed, that itself will not be impacting your score. There's got to be something else on there that would be impacting your score. Changing the lender name, the models don't even know that. Now, the only thing that I could think of that maybe is that you now, if it wasn't associated. Now, most lenders, the way they do it when they're transferring loans from one company to another, they send it under a particular code that says this is a transfer or a refinance or something like that. And then that way the models can keep those two accounts together. If for whatever reason, I'm guessing here at this point, right? If your lender did not report it, they just closed your account and then another company just opened an account, you might have seen a small drop because one, you closed one account, and two, the other account now is a brand new account, okay? The longer you have an account, the better. When it's first brand new, nobody knows anything about this, so it tends to be riskier. But every month that you make a payment, you get less and less and less risky. So that's the only thing that I can think of. So like I said, probably it's not the thing that dropped your score if it was done properly, or if it wasn't, it just looks like two independent loans. That could possibly be what might have been impacting your score.
That a little bit, I might chime in on that one if I may. Is this also make sure that the changing with the servicers, making sure that the loan is actually in the same status it was. So they might have been in forbearance or deferment or whatever that status was when it moved over to that new servicer. I would just double check and make sure that it is still in that status, like it's not showing that it's actually due. So that might be another thing as well with all the swapping with the servicers, maybe. Thought I'd chime in there a little bit and see if I was maybe
and
close to
check
that.
your credit report. Just check your report, not just your score. People always, check their scores, but it's important to check your report as well to make sure that all the accounts are being reported correctly.
Great. So why aren't auto purchases regulated like housing purchases? Seems like it's a huge budget buster. I'm not sure.
I would ask, what do you mean by regulated, like housing purchases?
Yeah, someone, if you could just verify what you mean by regulated by, so that we can see what the difference is there. We'll
Yeah, I mean,
yeah.
if we were talking about the whole thing where mortgages are deduped, right? Mortgage inquiries are deduped. I will tell you that auto is also deduped. Now, is a mortgage industry regulated more than the auto industry? Yeah. Why? Because we're talking about a huge ticket item. And the government in particular is much more interested in making sure that people don't get stiffed on a mortgage. You know, the whole mortgage meltdown that happened. I mean, you guys may be too young to remember this, but it really impacted the economy. We do not want a repeat of that. So mortgages and the whole housing industry is regulated, and rightly so. I mean, we need it to be regulated. We can't just have people willy-nilly running around. But auto is treated a little bit differently, but mostly it's because it's a smaller ticket item.
Right. So why does it ask for the long extended version of your creditor name when trying to view credit report? It says, I got messed up by this and was denied by my credit report. The problem is most of us don't know the long extended version of the creditor's name.
So I think what you're asking is, when you tried to access your credit report, and I'm assuming it was through annualcreditreport.com, there is something called an authentication process. Essentially, we're trying to verify that it is you. You are the person who's actually trying to pull your own credit report. So we're going to ask you questions about what's on your credit report. And some of the questions are like, you know, who issued your auto loan in 2020? I don't know, whatever the question is. And you're asking, why do they use abbreviations, or why do they request the long name? I will tell you that, as far as I know, all authentication pieces from the 3 bureaus, they do not ask you to type in the name of the creditor. They ask you to pick the creditor from a multiple choice list, in which case you don't have to worry about how it's written. It's going to be exactly how it's in your credit report. You just have to know which one it is. So unless you, I can't think of any other company that would authenticate by asking you to type in the name of your creditor. But if that ever does happen, which I think is weird, hopefully you have an existing copy somewhere. You should, by the way, when you do pull your credit report, you should keep those copies, either as a PDF on your computer, or, you know, printed copy if you are so inclined. But that would help you go back and look up and see how that creditor's name is listed. I will tell you that because of space, almost always the lender's name is abbreviated. And it has to match their official name, not the way you know them, right? So you might know, oh, this is Chase. Well, Chase is JP Morgan, and JP Morgan Chase is the actual name of the company.
Right. So if someone doesn't have a credit card and has never used credit to buy anything, do they have a credit score?
If you don't have any other loans besides credit cards, so no loans at all, no service accounts, no collections, no bankruptcies, you probably do not have a credit report. And there's an easy way to go check annualcreditreport.com, and it might say you will get what's known as a no hit, a response that says you do not have a credit report, or we were not able to find your credit report. In which case, we're going to talk about that, which is how to start a credit report.
So can you increase your score by making multiple payments a month before the due date?
Nope. The only thing the score looks at is, what is your balance? Did you make your payment on time? What is your utilization? How many trades do you have open, etc. So making multiple payments doesn't impact your score.
So how much does keeping credit card usage to 30% matter when you have 200,000 in student loans?
Well, if those $200,000 in student loans are in repayment, not a lot. You're right. That 200,000 is going to be a bigger impact. But the reality is that not everybody has a student loan, but almost everybody has a credit card. By that, I mean that models are looking at that credit card. So keeping your utilization down is important. And it's the one thing that you can actually have a direct impact and see a change relatively quickly, especially if you have very high utilization and you bring that down to lower utilization. But if you're, let's say you're at 20% or 28% and you bring that down to 15%, you're not going to see a big difference because it's all under the 30. So you're not going to see a huge difference there.
And I don't know if you would be able to recommend any credit cards, Veronica. Do you have anything that you would say about that?
Yeah, no, absolutely. So not specific credit cards because every person has a different need, okay? It depends on what you're going to be using that credit card for. For example, some of us, we use credit cards, what's known as for transactions. We are considered transactors. What that means is I use my cards and at the end of the month, I pay them off. I use them for convenience. Other people use credit cards sort of as a loan, right? Oh, I need to go buy a refrigerator, something like that. And I'm going to use that loan to pay it off over time. You are then called a revolver. It means you carry a balance from one month to the next. Even if you're making your payments on time, you keep a balance. I'm not saying that one is better than the other. No, they're two different actions. But if I'm a transactor, guess what? I don't care about interest rates because I'm never going to incur an interest rate. But I am going to care about fees and I'm going to care about the annual payment. I travel. So I love my credit card that gives me points towards my travel or hotels. Those are the ones that I use. Since I don't care about interest rate, doesn't matter. Other people do care about interest rates. You guys are pretty young, so you probably may not be able to pay off your credit cards in full at the end of every month. In which case, yeah, you need to look at those credit interest rates to see who's going to get you the best one and which one doesn't charge you a lot of annual fees and things like that. So there is no one card that's best for everyone. There's no such thing. However, there are tools that you can say, here's what's important to me. This is how I use credit, etc. What's a good one? And in fact, there is a program at Experian called Credit Match. And what we do is we compare all kinds of credit cards across the board. And we look at your credit report and we say, okay, you got to have this much credit score or whatever. And you kind of direct what's important to you. And it will give you rank order the credit cards that match your best, whatever. And here's the clincher. You probably know this from like Google or whatever. Participants in these rank order programs can pay to get their name up higher. Okay, they're called sponsored. With Credit Match, you cannot. If you were a lender, you want to participate in this by offering your products to consumers. The only way you can get to the top of the list is by giving the best offer. Okay, a lender cannot, be a bigwig and say, I want to be in the top list or something like that. Nope, only based on what the consumer is looking for. Low interest rates, points, low fees, different kind of benefits, whatever that is. So go check it out.
Great. Veronica, are you familiar with a HELOC loan?
Oh, yeah.
You are. So how does credit apply to this type of loan?
HELOC loan functions as two different types of loans. These are fantastic questions. I mean, these are so awesome. Okay, a HELOC is the baby between a mortgage loan and a credit card. Okay, it is a line of credit, so it works like a revolving line of credit, but it is secured against your home. So it is a mortgage and like a credit card. So what that means, but in addition, it has even one more step above that. So HELOC is when you take a line of credit against the equity in your home and you can use it to, do whatever you want, actually. So while it is included in your revolving, so your utilization, remember your balance divided by your limits, that applies. But it also looks good because a mortgage account is always a great addition to your credit report. So it looks good there. But here's the clincher. Some HELOCs have what's known as a draw period. Okay, so let's say you take out a HELOC, and then for the first 10 years, it acts like a credit card or a line of credit, a revolving trade. You pay, you take out, etc. But at the end of draw, it stops being a revolving trade and it becomes a loan. You can't take out anymore. Now, whatever money you used, right, whatever your balance was at the end of draw, that now becomes a fixed loan. You now just do the paying back, okay? That transition could have an impact on your score because the line of credit is now gone and a new loan has just appeared. It'll look the same. It won't change names or anything like that. But from a credit standpoint, you now have a loan versus a line. Okay, so they're very reasonably rated loans. There's nothing wrong about them, but just be aware of that. Okay.
Okay, good. I'm curious about the answer to this one myself.
Okay.
So I have a Chase Freedom card and a Discover student card, and both of those apps show me my credit score through Chase Journey and FICO. Which one is my actual score?
Both of them. By the way, I'm the product manager for Chase Credit Journey. So yay! I'm glad to hear that. Here's how it goes. Number one, and I think I mentioned this in the video, there is no one credit score. Okay, so when you say, well, what's my true score? It depends, you know. Where did you get that score? It would be like saying, well, what's my one grade? Like, grade on what? What's, you know, what class, what test, whatever. It all depends on where that score came from and what your lender is using. So what's happening with these programs is all lenders, Chase, Bank of America, all lenders, okay, they not only check your credit when you apply, but once they grant you that card or that loan, they can periodically check your credit again, just to make sure that you haven't gotten really risky or something like that, okay? So they're going to pull your credit report. Now, big companies like Chase, they actually pull your updated credit report every single month. It's for their own internal risk policies. It's part of the process to manage this portfolio. What they were saying is, and when they came to us and said, hey, since we've already got the credit score, you know, we already used it, can we have what's called secondary use? Can we use it for one more thing? And that's to give it to my consumer and let them know, hey, here's your new updated score. So they didn't pull the score on your behalf. They were using it for themselves. And they just said, hey, by the way, I got the score for you. Would you like to see it? Okay. So all it's doing is it's showing you one of the credit scores, primarily the one that they're using. So it's really important that when you're looking at Chase Credit Journey, they're showing you the Chase or the score that Chase uses. That's very important. But if you go to someplace else, Discover or Credit Karma or wherever, they might be pulling a different score. It's no less accurate. It's no less real. It's just for a different lender. So they're all your actual credit score. Just and hopefully they're not too crazy different. They should be roughly the same.
Great. This user says, I'm an authorized user on my parents' card. Is that enough to help establish my credit, or should I get one on my own name?
Definitely the excellent way to start, okay? And if your parents are awesome about keeping their credit history good, then it's probably providing a good background for you. But yes, you want to start credit in your own name as soon as you can. So use that authorized user card to get you started. So now you have a credit score, and now a lender can issue you a credit report, as opposed to saying you don't have any credit report at all, there's nothing for us to do. They could actually decline you for saying basically they can't find a credit report on you. But absolutely, as soon as you can, get credit reports in your own name. You don't have to necessarily get off of your parents right off the bat. But just be aware that, like, when they decide to go on a shopping spree, they're going to go on vacation and they put a lot of money on that credit card. That debt shows up on your credit card, on your credit report, at least until they pay it off. So it's better to have your own.
Great. Now, Veronica, we have about 20 minutes left. Are you still okay to keep doing
Are you?
questions?
Yes. No. Let's keep going.
We still have a lot of questions, so as long as you're okay with that.
Jonathan,
so
I think we need to have more of these.
Yeah, we do. We do. This is sort of a little bit of a repeat one, though. How can I get started without a social security number?
So that is a tricky one. From our standpoint, you don't have to have a social security number, okay? But from the lender standpoint, you usually do. So we don't direct lenders. So without a social security number, you might be able to, for example, there's something called an ITIN, right? It's a social security kind of like, but it's really for tax purposes. So it's not a social security. Remember, social security is for your retirement benefits and you know, authorization to work and all that. So it has specific uses. From our standpoint, it's only used for identification, nothing else. It is not like the Holy Grail, you have to have a social, it's your number, no. So to not have it, you're going to have to go to have a lender who's willing to issue you a card or a loan without it. Once they start reporting, bingo, your credit report has been started. So you don't have to do anything else. But you do need to find somebody who's willing to issue you a loan without that social security number. And you know, I couldn't tell you who that is.
Great. Is there any impact on not using a credit card at all?
Yes, if you don't have a credit card, it will negatively affect your credit report. Also your life. It's very inconvenient to go through a life without a credit card. You can't even rent a car. Okay, I mean, just simple things like that. But what are the impacts? It's not helping your credit report. And as I mentioned before, if you have a credit card and you just don't use it, within 2 years, that lender is most likely going to close you. And then you're going to have that lender closed account.
Yeah. So I have heard student loans don't impact your score, but once I got my loans in my first year of medical school, my score went down 30 points. There are no other changes that happened, so I'm not sure why. Can you help
Okay.
me with that?
I do want to caution you when you say no other changes happened, your credit report is changing all the time. You may not see it automatically, but it is changing all the time because every lender, and I don't know if you have one trade, if you have one student loan, or if you have 50, there's activity. But aside from that, um, the loans on your credit report that are related to student loans specifically, they vary based on whether they are in deferment or not. If they are deferred student loans, they show up on your credit report, but there's no history because you haven't paid on anything, right? So think of them as a somewhat dormant account. Once they go into repayment, or if the type of loan that you took out is perhaps maybe a private loan, a private student loan or something like that, it could start showing up. And if there are payments to be made, balances being reported, then yes, your score is going to drop. Now, 30 points seems like a lot, but that could also mean that you have a very thin file. If you have a very thin file, every activity is going to drop your score. So you need to be vigilant and build up that thickness, if you will, of the credit report so that it stabilizes a little bit more. But just so that, to summarize, deferred student loans show up on your credit but have very little impact on your credit score. But not all loans are deferred. And the minute it goes into repayment, it becomes an active loan like anything else, like if you went out and got yourself a car or whatever that happens to be. Okay.
Good. So this person says, I have recently fully paid off a credit card that was specifically for furniture store, and I don't intend to use it anymore. I was told by the store the account would be closed out after inactivity, but would it be better for me to just close it out myself?
Yes, it's better for you to close it so that it says consumer closed than lender closed.
Great.
Yeah.
So if your student loans were paid off, say through public service loan forgiveness or any other loan program, how does that factor into your credit score, or does it make a difference?
It does, because now your score goes down to zero. And hopefully it's closed as paid as agreed. It goes into the historical portion of your credit report. It's helping you because they always look at the history as well. So it's showing a completely paid off account. Now, do be aware that once it's closed and paid off, it only has a 10-year shelf life. After that, the entire loan and its good history also drops off.
Okay. I'm a medical school student living solely off student loans. I have a good amount of credit card debt and the minimum monthly payments are killing me. What advice do you have to rather lower these payments or pay the cards off with no real income?
Ooh, that's a lot to unfold there. But okay, here's what I would recommend. If you, like I said, if you can't make the minimum payments, there's two options. One, talk to your lender and see if you can't get those payments reduced or some kind of forbearance or some kind of reprieve. If not, you could also take a loan consolidation, which is where you take a single loan and you pay off the credit card so you're not getting the multiple charges, and perhaps get a payment that is more manageable, something that you actually can pay off. But just remember, though, that just because you don't have income doesn't mean that your loans go dormant. You still have to pay them. You still have to find a way to pay them, or else you are very likely going to be what's called charged off. And charge off is a default on a loan. And lenders, when they're, in the future, when you're looking to get new loans or a car or something like that, they're going to look at that and say, this person doesn't pay their bills. So, just be aware of that. But look into a loan consolidation if it works for you, if it makes it reasonable.
I was living in Canada before I moved here to the US. Would my credit score in Canada affect my US credit score, good or bad, or will I be starting from scratch?
You will be starting from scratch. At this point, there is no international credit report. It is purely within the United States, and nobody checks Canadian credits. Not here.
This might be along those same lines. Says I will be starting to work in the US next year as a resident, but this year I've been paying all of my bills on time. When I start building my credit next year, would I be able to add in my CPD to my history?
The only consumer permission data that is permissible at this time is rent in the US, right, rent, utilities, and insurance payments. So if you were paying those to outside rent to other countries, then no, unfortunately, you will not. You will have to start building here, start your credit report, start boosting with whatever cell phone or utility bill or rent you have here, and give it a few months and it will start building your credit.
Veronica, before we keep going, I'm going to do one thing real quick. I'm going to share up our, can everybody see this okay? I wanted to share our survey so that everybody can start to let us know what you think about this talk, because this is brand new. We're probably going to wear Veronica's voice out by the end of it, but we are going to keep going. And I'm sure Veronica's okay to go past the hour if we need to, but I did want to put this up here so all of you can give us your feedback on what you think about this format, how you like this Q&A, okay? So just if you don't mind, scan that, let the AAMC know what you think about it. But we're just going to keep going. That was just a quick little plug there for our survey, because we do want to hear what you say about this. So we'll keep going. Looks like someone here, Veronica, had a little issue with debt consolidation, saying that it had a very negative impact on the credit score.
It can, yes, it can. Not because it's a debt consolidation, but because it's a restructuring of your loan. Now, there's another thing that I want to do. I do want to kind of make mention. There are also credit counseling type of hits. Those can actually be negative. They can be marked as a negative on your credit report. Usually what's called debt consolidation or balance transfers or things like that, they tend to be a wash. Now, I don't know everything that's on your credit report, okay? I don't know what were the conditions of that loan. Did anything by intent go into default or go late? Did you add any debts to that? But just on its own, basically moving balances from one account to another, the only negative impact that it could have is that you now have a new loan, okay? And usually at the start of every new loan, you become slightly riskier, so your credit score could drop, but it usually fixes itself up fairly quickly within 6 months or something like that. As long as you've been making your payments on time, it usually looks good. If when you did that loan consolidation, you closed all those other accounts, that could have dropped your score. So there could be many kind of considerations there, but loan consolidation is sometimes the only way to help somebody manage their cash flow issues. So everybody kind of has to balance that out.
Okay. So can you talk a little bit about the strategy of using a different credit card, opening a different credit card to maybe help pay the balance on another different card?
Oh, yeah. Playing like Russian roulette with your balances. That's not a way to manage your money. It really isn't. For starters, this isn't free money. Okay. Every time you make that transfer, you start using one credit card to pay off another credit card, like basically balance transfers, you get charged a fee on top of that. So eventually that becomes very, very expensive. You are much better off if you cannot make your minimum payments to talk to your lender and work out something than to try to rotate your balances. That is not a long-term strategy, or not even a short-term strategy, to be honest with you, because you will be charged for that.
So here is one that a little bit of a three-part question, but I think you've already touched on a lot of this.
Okay.
So what's the best way to handle a closed credit card account?
Yeah.
How does a closed credit card affect your chances of getting another credit card? And once paid off completely, how long will it take for your credit score to be improved?
Okay. So the first question is, what was it about?
It's like, what's the best way to handle a closed credit card account?
So I don't know what you mean by handle. Once you close an account, your utilization has changed. You now have a closed account. There's nothing really to handle. I would recommend that if you are going to close an account, especially a credit card that has a certain limit, to have the minimal negative impact on your credit score, you should open another card that has at least the same credit line, right? So your utilization doesn't go off. But that's really it. And also make sure that you're the one closing the account, not your lender. What was the second question, Jonathan?
It was just, how does that affect your chances of getting another credit card? Once you close one out, does that affect your chances of getting another one?
Under certain situations, it could be more difficult. Let's say it's your only card and you closed it. Now a lender is looking to see how many open accounts you have, and maybe you don't have any open, so that could be negative. If you have a bunch of other accounts, it will have a minimum impact. Right, so you can, close an account, open an account, that's not a problem. They're just looking to see, are you making those payments on time? Are you keeping your payments low, et cetera, or your balance is low?
And
And what
once
was
you
the
pay
other
off a
part?
credit card, yeah, the other part was just like, once you pay off a credit card, how long does it take for that to show your credit improved? Like, how long will you see does it take for your credit to look like it's improved after that?
Always depends on what else is on your credit report, but as soon as that lender reports the new balance, your credit score could be impacted. How much depends on what else is on your credit report. So if it's your only credit card, yeah, it could probably have a pretty immediate impact. If it's one of 10 credit cards plus a mortgage and an auto loan, probably very, but at that point your score is probably pretty good. So the improvement might be minimal, but the impact is as soon as they report it, you now have a new credit report. And if there's a credit score that's hit off of that new credit report, it's going to show the zero balance right off the bat.
Okay.
Immediate.
Are there any legitimate debt consolidation companies? In other words, ones that are there to help you get out of debt versus make money off consolidation?
So a lot of lenders will have loan consolidation programs. So, I mean, what I would honestly do, I can't recommend any particular company. And I do know that there are some shady companies. You got to be careful about that. Look for fees. Really look for the hidden fees. But if your bank, let's say the bank that you currently work with, or a credit union or something like that, you can say, hey, can I take out a personal loan for X amount of money? Essentially, you are creating your own debt consolidation. And you're moving those, paying off the other cards and things like that with this new loan. And it'll just show up as a new loan and see how much money they can give you. It's not going to, it doesn't get recorded as a debt consolidation. There's no recording of that. It just old accounts go to zero and new accounts show up. My strongest recommendation for you is work with a reputable company, work with a good lender, somebody that you are familiar with and who has got a good reputation, and look for fees. That's the most important thing. If they're charging you 2%, 3% of the balance to transfer this, that's going to add up like really quickly. So just be aware of that. But yeah, just look for a reputable company.
Okay. Is it true that when you're checking your credit score or your credit report frequently, it could drop your credit score?
I'm so glad somebody brought this up. No, I don't know where this came from. Somebody put it out there on the internet and it's been floating everywhere. You can check your credit report every single day if you wanted to. It will have zero impact on your score, because when you check your credit report, that is a soft inquiry. Models, all scoring models, are prohibited from using soft inquiries. So there's no way it could impact it. Okay. Only hard inquiries can impact your score.
Okay. So if you got a notice that your loans were forgiven, but they're still on your credit report, what would you do?
They're going to be on there until they purge. Remember, this is a credit history. This isn't instantaneous. When you pay off a debt, whether it got paid off for you or whether you're paying it off, it updates, but it doesn't disappear. If you had a collection account, you paid it off, it doesn't disappear. It just gets updated with it's paid off, and it stays on for another 10 years and then it drops off. So there's nothing you can do except wait 10 years, but don't worry about it, because at this point it's saying zero balance due. Yay.
Right. Here's a really good one.
Yeah.
What's the difference between a loan and a credit line?
Oh, excellent. A loan is a fixed term amount. You're taking out a loan for $10,000 to buy a car, buy a refrigerator, buy whatever. It is a fixed term. So you take out a specific amount, you pay it off over a period of whatever terms, 3 years, 5 years, 30 years, whatever that is. It's called a term loan. And you don't keep adding to it. The balance, every time you make a payment, your balance goes down, 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 down until zero. Then the account is closed, paid off. A line of credit is on the day you open your account, you're at zero. Remember, with a loan, the day you open your account, you're at 100% using, right? You've got the entire amount. Whereas with a line, the day you open your account, you are at zero, and you only add to that when you use that card or use that credit line for something. Then you have a balance. You can pay it off, or you can pay a portion of it off. You can add, subtract, add and take away constantly. That's the difference between a line, which is like a credit card or something like that, versus a loan, which is also known as a term loan.
I'm going to ask you this one, but I think we already answered it in a way. I moved here a year ago from Europe and only have a debit card. Will I have a credit score in the US?
No, debit does not apply to your credit score. You need to, if you really don't have anything, hopefully you're making some payments either to rent, utilities, cell phone, insurance, something like that. My recommendation would be go to Experian.com/go and start your credit report. And then go to Experian.com/boost, BOOST, and start adding those trades to there. And at least you will have a credit score. Then you can apply for a retail card or a credit card or a little loan or something like that and start building your credit. Debit, unfortunately, does not build credit because it's not a loan. It's your own money.
You answered that perfectly. To piggyback into the next one, you've mentioned a lot about great programs for us like Experian Boost, Experian Credit Match Program. Are there any other programs that you would recommend?
So here's what I'm going to tell you. And granted, I'm being biased because it is my company, but I will also let you know that the other bureaus do the same. So I'm not just pitching us. At Experian, we are very invested in having consumers really get a handle on their credit. So we have lots of programs. Experian.com, go check it out. The Experian.com program is you as a consumer, totally for free, can sign up for what's called an Experian membership. You will get a credit report, a credit score, and credit monitoring. Okay. Now there's also all kinds of other programs that you can upsell to if you want to pay for additional, but for those 3 programs and credit education, by the way, those 4 programs, totally free, go sign up for Experian.com. If for whatever reason you do not have a credit report, if you go to Experian.com/go, G-O, that's how you start. You create your own by entering your own information and saying, I want a credit report. Here's my information. Okay. When you do that, though, your credit report is still empty, technically, because there's no trades on it. That's when you then go to Experian.com/boost, and then it will walk you through how you add things to your credit report from utilities, rent, insurance, and cell phone companies. Okay. At this point, those are the only ones that you can add. But and when you go there, there is a ton of articles and presentations and videos that teach you what you need to do to get started. But those are the 3: Experian.com, Experian.com Go, Experian.com Boost. Those are the 3 you should start with to start getting your credit going.
Perfect. Which is more beneficial, applying for a new card or requesting a credit limit increase?
Credit limit increase.
I didn't know that, so I'm glad somebody asked that question. I want to open another credit card. Is it possible when I'm living on student loans?
That depends on the lender. Sometimes lenders are going to say, well, a lender will always ask you, what's your income? Okay. And if you put 0, you might get declined. Okay. Remember that it's not just about a credit score. You usually have to show something. So if they allow you to say, theoretically student loans or grants or whatever, they are like an income, right? So same thing as an alimony and some other types of alternative incomes, but usually they count. That's what's going to be the decision of whether or not you can get the loan. And a lot of it's going to be depending on what kind of loan you're taking out, what kind of credit limit. Remember that the lender has to limit their exposure. They don't want to, if you stop paying, they're out that money. So they're going to have to limit that exposure.
Is there any way to erase bad credit history, like late payments?
It's called purging. After 7 years, it purges. You cannot erase it if it's real. Now, if it was wrong, it was never supposed to be there in the first place, and you can show that you either did make that payment or it's not your account or something like that, then yes, you can have that removed. But if it was actually you, unfortunately, it just doesn't.
Okay. So my father has a 660 credit score and keeps getting rejected for a card. Is there any reason behind this?
Yes. Each lender sets their credit limit and their risk threshold at a certain point. If at 660 he gets rejected, most likely that lender set a minimum of 680, or it could have been lower, but there are other things. Maybe his income isn't enough. Maybe there is a bankruptcy, in his past. I'm just saying that it's not just the credit score. There are many things that go into a decision, but let's pretend for a second that the reason he's being declined is that his credit score is too low. That just means that that lender has set their minimum threshold at a higher number.
Okay. So not to affect utilization, should I open up another credit card before closing a credit card?
Yes. Yeah, or at the same time. Remember, all this, you only get reported once a month, so it's not like it would happen like in a second.
Great. What date of the month are you supposed to pay off your credit card?
Just before its due date. And you don't have to pay it off. You just have to pay the minimum at least. Now, if you want to pay it off, great.
Great. What are hard inquiries?
Hard inquiries are when you give permission to a lender to check your credit for the extension of a loan or a credit line or for service. You are giving them permission to check your credit report to see if they're going to either approve you or decline you or to give you a different rate. That is a hard inquiry versus a soft inquiry is when you check it or when your lender is doing its monthly checkup or for pre-screen offers. Those are all soft, don't count. But when you say, yes, please check my credit so that you can give me a credit card or a loan, that's a hard inquiry.
Okay. What's a good credit score?
It all depends on the lender. Usually for a mortgage, you got to have a 620 or 660, depends. But if you want the American Express Black Card, you better have like an 800 or above. So, but generally speaking, a 680 and above is considered decent enough to get you most loans, but not all loans.
Okay. How can I check my credit daily?
You can go daily. You're going to have to pay for that because you only get free ones every so often. Right now, until the end of the year, you get a free one every week through Experian.com. But if you want to check it daily, you're probably going to have to pay for a service and pay for each credit report. And by the way, your credit, while it fluctuates, it's going to be like 99.9% the same. So there's no need to check it daily.
Okay. Are there any good rebuilding credit cards that you could advise?
Rebuilding credit cards, honestly, it's the credit card that's going to approve you. So how should I put this? Work with your bank or your credit union to see if they will give you a either secured card, especially if you're rebuilding because you had some trouble in the past, like a bankruptcy or whatever. You could have a secured card, or retailers sometimes will issue you a card if you've had some trouble in the past. What they're going to do is they're going to start with a small credit line. They're not going to give you a big credit line. But as you start showing good payments, after 6 months to about a year, you can request that they extend your credit line, give you higher limits, because now they're seeing that you're making your payments on time. You're a better risk. And just unfortunately, rebuilding is a slow process. It does take about a year or two.
Okay. So I got declined a credit card from Costco when I just came to the US because I don't have a social security number and used my SIN from Canada. Will that affect my credit score when I start next year?
No, because you didn't have an SSN. That means Costco requires an SSN for them to issue you your loan. But it just basically hit and it just says inquiry. Doesn't even say what the result of that inquiry is. So, it's not going to affect your credit.
Okay. Is there a disadvantage of having all of my credit cards with the same lender?
Nope. Models do not see the name of the lender. They just see what kind of account is it. What's the limits? What are the payment history? What's the balances? So the subscriber, it doesn't even show up on models.
Perfect. And Veronica, how often do you recommend we check our credit report?
Once a year minimum. I would say a couple of times a year. If you to keep up on it. And I will say, definitely check it before a major purchase. If you know you're gonna be taking out a car loan in the next few months or a mortgage, check it at least 3 months before you need it. So if you have to make any corrections, repairs, or anything like that, you can do it well in advance.
Perfect. And this one says, if I have a thin credit report, how much does closing the oldest credit account impact my credit score?
Not immediately, but in 10 years it will drop off and it will impact your score a lot. Because now thin scores are very vulnerable to changes in information. That's why you want a thick credit score so that little changes have minimal impact.
Great.
What was that last
Well,
question?
believe it or not, there was one that said a percentage. I think they might have percentage of income that could be used for the purchase. I'm not sure if you know what
That
that.
might be for mortgage, and again, there are rules that different lenders have as far as, they'll issue you a mortgage loan for, what was it, 2.5 times your income or something like that. Every lender has a different criteria. You need to ask them what is their, what's called, income minimum requirements for issuing you a loan.
Well, that's great. Looks like you have answered a ton of questions. I think you're gonna have to chug some water after this one. We do appreciate, Veronica, you coming. Did you have any closing remarks or anything for everybody that you wanted to show or talk about or anything?
Since I didn't get to go through my presentation, I'm going to PDF it. I'm going to send it to you. And if anybody is interested, at least the information will be there for you. Okay.
That's amazing. And we cannot thank you enough for basically sitting here and answering all of these 50 something questions that came through. And we also can't thank all of you enough for participating in really our very first interactive webinar. And we think it's been a great success. A lot of great questions were asked and answered by Veronica. So again, here's our QR code. Please let us know what you thought about this. We'll use your answers and your feedback moving forward and how we, set up our future webinars. We could do half and halves. I know Veronica had a lot of great content in some slides that she was going to show to us, but she'll send those over to me in a PDF form so I can make sure to share those with all of you. But we had a great time today, Veronica. Once again, been amazing working with you. Been great to have you pair with us at the AAMC. I am certain, based on what we're going to hear back, we'll do it again soon.
Sounds great.
So with that being said, everyone, enjoy the rest of your day. We look forward to seeing you at our next webinar, and we'll talk to you soon.
Thank you.
Bye, everybody.